Today we're talking about how much money to raise. This is a big question that I've dealt with dozens of times, if not well over 100 times, with companies that I've worked with on raising capital. It is the number one question of all entrepreneurs that are going through a growth spurt and need money in their business to achieve their objectives. And it's not an easy conversation to have, because doing the projections and doing the financial modeling to help you really determine how much cash you're going to burn until you become profitable is always at best a guess. But the good news is sophisticated investors understand that. And more importantly, they want to see that somebody's gone through the exercise of the financial modeling so they can make it as best of a guess as possible. But let's talk about the strategy of raising capital and how much money you should be looking to raise. Think about Shark Tank. Now, there's a lot of aspects of that show that is very disconnected from reality, but the psychology of how a business owner gets in front of investors and interacts in those that win and get investment from the sharks and those that don't, that psychology has and will always be the same. The business owner that walks in with realistic expectations and is very welcoming to the sharks and suggests that they could invest and own a large percentage of the company, those are the people that are ultimately successful. And for the really good companies and the really good business owners, then a bit of a feeding frenzy happens, where all of a sudden they're getting a better valuation, they're getting more money than they had originally planned on. And that's where you want to be. So when you're looking at how much money to bring in and what is the valuation of your company, keep in mind the investor psychology that is naturally going to play out when you're having these conversations. And don't get me wrong, I don't want to convince anybody to sell more equity than they need to, because it's very important that founders and the executive team own a meaningful piece of the company. But you have to keep in mind what are the things that are going to happen when it comes to raising money that is going to get you in the door. So when we work with companies, we look at the target market. And when you're raising a certain amount of money, what doors is that going to get you into? And what doors are you not going to be welcome into because the amount of money you're raising may not be a fit for them? So if you're dealing with angel investors, by default, it's likely going to have to be under $1 million. When you're dealing with more institutional investors, it's going to have to be $5+ million. And yes, you've got me right, that especially $2 to $5 million is still purgatory. It's a difficult amount of money to raise, because it's often too much for angels and it's too little for institutional investors. However, that's changing quite a bit because of super angel funds and the sheer fact that venture capitalists are starting more and more to invest from their personal accounts to invest smaller amounts of money so they can get in front of the next Facebook and the next big thing. Because the reality is that our technology companies don't need the level of investment that they did even 5, especially 10 years ago. So to wrap this up, when you're thinking about how much money to raise, pay attention to your financial model and make sure you've got plenty of cushion. My rule of thumb is to double it. If you need $500,000, double it so you can be safe. And then to figure out your target market so you can go get in front of the investors that you need to speak with. And you put your best foot forward, and you've got the best likelihood of being successful. And never forget, people invest in people, first and foremost. With this and additional resources, check out INVESTyR.com. And don't forget, invest your reputation. Thank you.